Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. It's another big week on both sides of the Atlantic, from earnings to central bank decisions and, of course, the long-awaited Supreme Court tariffs hearing. Asian markets and global futures, however, edging higher. Of course, off the back of last week's summit, China has agreed to pause sweeping controls on rare earth magnets in exchange for a U.S. agreement to roll back an expansion of curbs when it comes to Chinese companies. And one eye on oil, very much in focus, as OPEC Plus continues to pause output increases during the first quarter. This comes after making another modest hike next month. The decision, of course, facing a backdrop of geopolitical risk from Venezuela to Nigeria. Lizzie.
Well, happy Monday, Kriti. Checking in on the rest of the market, and it is risk on to start the week and the month. We have futures pointing higher on both sides of the Atlantic. The S&P already ending October at an all-time high. And when it comes to treasuries, it's a holiday in Japan, so we've just opened for the trading cash treasuries, the 10-year US Treasury yield at 4.09%. The countdown to the opening trade starts right now.
Monday the 3rd, good morning. Hope you had a great weekend. Setting yourself up for a week ahead that is packed with events that you need to worry about. Are we going to see significant volatility this week? What events should we be focusing on? That's probably where we should start the show this Monday morning. Monday is kind of quite quiet. As Lizzie says, we're kind of risk on. But look at the events that you've got coming up on the docket this week. The one that really stands out to me is the Supreme Court hearings. They're going to start this week on 60% effectively of the Trump tariff package. If they were to be struck down, and this is not the kind of expectation, but say they were and say that happened, that is a huge kind of tail risk event that would have a massive impact in terms of how markets are going to be viewing the Trump package. It'll have a read across into the Treasury market. This is a huge event. And the Trump administration is clearly nervous about it.
They're clearly nervous about it. We also won't get a decision necessarily before Thanksgiving or even going into December or January. What is crucial, though, is that there are going to be court reporters in the room who could be reporting on that. And this is where we're going to kind of put, I think the markets are going to be putting the same hat on they put during Jay Powell's press conferences, which is really just diving into every possible line to see which ways things can go. That being said, it is widely known that there are plenty of backups from the White House administration that if this does get struck down, could there be other ways that they then put it forward?
But it just makes it more difficult, makes it trickier, and calls into question the revenue-raising sort of exercise.
And the refunds.
Precisely. Refunds, all kinds of turbulence around that event.
Indeed. And then on Friday, we have more US data. Of course, we've also got the mayoral elections coming out of the US this week.
Yeah.
Is it tomorrow?
Yeah, tomorrow.
Yeah, so we've got to keep an eye on that.
Yeah, that's going to be significant in terms of setting the tone and going into the midterms as well. Does that have a read into how maybe the Democrats are going to revitalise their position going into the midterms?
Yeah, you've got the Virginia special election, plus, of course, Mamdani, who is very much ahead of the polls. If we're talking about taxation and one of the world's largest financial capital, this could be the mover.
Yeah, we should say that Michael Bloomberg's endorsed Andrew Cuomo in the mayoral race. But I'm also watching the Bank of England rate decision on Thursday. Of course I am. But look, they're expected to hold. The risk is that maybe the guidance changes and it's less dovish. We've had lots of data coming in softer than expected in recent weeks, but I reckon they're going to want to wait to see what happens in that budget. Yeah,
we'll talk about the budget a little bit later on the show as well. We've got a boatload of earnings coming out through Europe this week. Like last week, the focus was very much on the United States. Less of a focus on the United States, more of a focus on Europe this week. We're going to be talking about some of the big names that are coming out. Novo Nordisk is on Tuesday. Watch that one. There's a massive M&A story around that as well. You've got some of the big defence names as well reporting numbers, plus some of the airlines. We've heard from O'Leary this morning. You've got IAG later on this week on Friday, owner of British Airways and Iberia.
Yeah, plus BP and Aramco, of course. We saw Chevron and Exxon come out with some pretty strong numbers on Friday. We'll see if their European counterparts can do the same. Let's talk about what happened last week. Now that we've talked about what's coming in the week ahead, I think we should look in the rearview mirror. It felt like we left the office Thursday, Friday, thinking everything was fine between the world's two largest economies, at least for the next 12 months. Over the weekend, it does feel like some animosity has come back.
Of course. This is just a holding action, isn't it? This is just we're going to get a few deals done. Not sure how much soybeans are actually going to end up being bought. We're not entirely sure how the restrictions around rare earths are going to work in detail. You're still in the ring. These two are still in the ring. They've backed off to their corners. but they're circular. They're going to be out circling each other soon. The next round will be up really quickly. Is it a 12-month pause? I don't know. Maybe it's shorter than that. Doesn't feel like the end of the road, though, does it? China and the United States are still looking at each other eye to eye. And the tone as well this weekend in the reporting I read was that China came out on top. Out of these talks.
And to continue your metaphor, we're still trying to work out who has the upper hand, and every time we get more data, we look at who has more leverage. So that latest China manufacturing activity data showing they expanded less than forecast. This is private survey data, but it's another worrying sign for the Chinese economy that it's how you play your hand, right? And the rare earths hand has been played very well. It has.
But this morning we're risk on because at the margin, if you take the arbitrage position on this, you've downgraded that risk a little bit. You saw the AI story performing reasonably well last week, continuing basically to spend huge amounts of money. That's going to keep the train on the tracks. You've got some data this week. I think we get ISM manufacturing at the beginning of the week. We get services at the back end of the week. We've got UMich at the back end of the week as well. We're not getting the data that we would normally have. So, yeah, it feels like a kind of risk on Monday. We're going into the new month, like new P&L, things to think about. Market feels kind of front foot rather than back foot at the moment.
Absolutely. Well, speaking of risk on, we should talk about the oil market as well, because perhaps that is where we're getting a little bit more action this morning. The oil price, $65 a barrel.
Yeah, so we knew that oil was going to be affected by the OPEC meeting over the weekend. They were expected to announce another small output hike for December, but the surprise has been that actually they're going to pause the hikes when it comes to next year. And then off the back of that, you've seen the oil price rising, and Morgan Stanley, of course, lifting its forecast to $60 a barrel for the first half of 2026. It was at $57.50. But we've got to fold in the geopolitics as well. So there's Nigeria and there's Venezuela. When it comes to Nigeria, Trump denying that Trump threatening military action in Nigeria because of the Islamist militants there. And when it comes to Venezuela, Trump denying that he's planning strikes there, but ships and planes suspiciously close to the coast. I would say, if you look at Nigeria, you could ask whether that threat to go in guns blazing is just all talk, given that the US doesn't have that much capability in the region anymore. And when you look at Venezuela, if Trump wants regime change, it's not going to help Maduro's successor if he blows up the energy infrastructure. So maybe keep an eye on those geopolitical risks, but keep your main focus on OPEC.
And we should mention that Chevron and Exxon, in their earnings on Friday, had very specifically actually addressed the conflict there, because Exxon does have a holding in Guyana as well and a presence there. Chevron had actually debated that, given the sanctions that are on Venezuela, whether they could actually hold it. Both of them talking about, of course, they have their interest there, basically saying that they want to avoid conflict in the region, but think that their presence should be there and should exist.
The other thing I just want to fold into this as well is that China is just buying vast quantities of oil at the moment and storing it. And you just when you think about going back to our previous conversation about China and its ability to provide volatility and to upend maybe the talks that we've seen between the United States and China, the ability to insulate themselves from geopolitical shocks, gold, oil, all of these things. They're also storing dollars in a way. They're storing reserves. And it's another backup that you just want to think about. So if the oil price is kind of reasonably stable, they'll continue to buy. Talking of the oil trade, ADIPEC, the Middle East's largest oil and gas conference, is firmly underway in Abu Dhabi. And later in the show, we're going to be hearing from the CEOs of Eni and ExxonMobil. We've got top leaders from Gunvor Group and ADNOC. If you want to know what's happening in oil, you basically want to pay attention to what's happening in Abu Dhabi right now to get a real sense of what is going on at the moment. And we'll bring you all of those conversations as we work our way throughout the morning. What have we got coming up on this show? Bilal Hafiz is going to be joining us very, very shortly. We've got Vishal Kanduja, head of broad markets fixed income at Morgan Stanley Investment Management. Broad markets, we'll cover those. Beata Manthi, Citi's European Equity Strategy Head, is going to be joining us. Michael Haig, SocGen's head of FIC and Commodities Research, to talk about gold, talk about oil, talk about silver, all of the things we've just been mentioning. Lizzie, coming up later.
Yeah, well, here's what else you need to know this morning. Berkshire Hathaway's cash pile surging to a record $382 billion in the latest quarter as earnings jumped at Warren Buffett's conglomerate. The firm's cash hoard grew as Buffett avoided deals during the quarter. Insurance underwriting profit more than tripled. Berkshire declined to buy back shares for a fifth straight quarter. And France is launching closed-door talks to rescue its 2026 budget amid a standoff that could topple Prime Minister Sébastien Lecornu. The political gridlock has driven French bond yields to multi-month highs and widened spreads over German bunds. The Cornu has ruled out using Article 49.3 to push the bill through, adding to investor jitters over efforts to curb Europe's largest deficit. And UK assets in focus as Chancellor Rachel Reeves weighs new taxes on the wealthy to plug a budget gap of as much as £35 billion. Bloomberg understands that options include an exit charge for rich Britons and higher levies on luxury homes, moves that could reshape property and capital flows. Treasury officials are said to have drawn up dozens of tax options for Reeves to consider. Well, she told me that she wasn't going to break the manifesto and she thought a wealth tax didn't make sense.
That has clearly changed. And I just want to give, they're looking at polling, basically suggesting that it's OK that it's changed. They need to find a way of filling the holes. Raising top-rate income tax is unlikely to do it. They're going to have to find other ways of doing it as well. The weekend was just littered with articles about tax rises.
Has she not learned from France that just because it's popular doesn't mean it makes economic sense? Yeah. Has she not learned from the non-doms exercise that if you clear out the entrepreneurs, it's not exactly good for growth?
Absolutely. But she's also learned that if you leave yourself little fiscal headroom, you are going to struggle. So what does she do? She has to raise taxes somehow, clearly cutting spending. She's tried that too, and that hasn't worked because it won't get through Parliament. How does she deliver enough fiscal headroom to keep the markets quiet and allow effectively the country to move on? I think that's the key question. Raising all of these taxes, the kind of tinkering around the edges aren't going to do it. She's going to have to pull one of the big levers, and it looks increasingly like it's going to be some sort of income tax rise. Yeah,
and the way to do that without technically breaking the manifesto would be to freeze income tax thresholds or to broaden the base for VAT.
The papers over the weekend were taking her further than that. She was going to raise income tax.
Yeah, which would be a manifesto.
Which would break the manifesto, which is why I come back to the polling. Clearly there is a willingness and understanding that she has to make some fairly big moves. And that seems to be what's coming out of the polling at the moment, that actually that everybody doesn't want the chaos to continue. They need there is a need in government and a recognition in government that taxes are going to have to go up. Simply tinkering is not going to do it. And the market will look through tinkering as well.
T-minus 23 days until the UK budget. We, of course, await that with bated breath. Coming up on the program, go back to the earnings picture. RyanAir posted a beat in its latest earnings print. We're going to check on the airline stock at the open. Here, of course, from the CEO, who just spoke to our very own Tom McKenzie shortly after the release. Plus, gold steadies after China ends some tax incentives on buying the precious metal. Doesn't really move the dial or the bull case. But up next, again, we're going to stick right back to the market story. Earnings, central banks, trade updates. We've got a lot to digest. We're going to dive into the market story next. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg. Some breaking news crossing the Bloomberg terminal, this time around the British oil giant BP. They're selling their interests when it comes to the Permian and their Eagle Ford assets over in the United States. Some of the onshore assets totaling to about $1.5 billion. This is crucial for a couple of reasons here. One, BP is kind of on a journey to divest. They really have to deal with a lot of their bondholders, a maturity wall coming up in 2027 that they're trying to deal with. So this is something that's been on their radar and an option they've been considering for some time. Here's what piqued my interest. They're selling those onshore assets to the private investor Sixth Street. It's really fascinating to see a private market player actually get their hands on oil interests, specifically in the Permian, where, of course, in the States, the domestic story guy is consolidation specifically for the Permian. And that, of course, has just been getting the green light when it comes to the likes of the DOJ. So BP getting out of a place where a lot of people want to get into.
BP's got its numbers out tomorrow. Why is it doing this today? What is that? Maybe tell us about the earnings. I don't know. Maybe I'm drawing too many dots.
Do it. Get that magnifying glass out.
I don't know. It's going to make the earnings a little bit more exciting. Are they going to return money to shareholders? What are they going to do with that cash? OK, let's talk about what we've got this Monday morning. It is the 3rd of November. We are starting a new month. It feels like it's risk on this morning, only just, as you can see by the futures that you've got in front of you at the moment. Bilal Hafiz says here, head of market strategy at Macro Hive. Is that still correct?
That's still correct, yeah. Well, Macro recently got acquired by BGC, so I'm not quite sure what my title is now.
We'll look forward to the next appearance and we'll find out. Markets risk on this Monday morning. Is that the right trade going into the new month?
I think it is. I think, we've had some really good news on the US-China news on the trade side. On top of that, the market got very excited about the possibility of the Fed not moving in December. And I think all the news in the next couple of weeks will be that they will likely cut in December. So all of that together.
And the AI trade is on, is it? This is the juggernaut that just keeps everything rolling forward, that keeps equities trundling higher.
Yeah, I think for now it all sort of continues. A big part of it is obviously the capex trade that the AI companies are doing, and as long as they keep committing to it, it's one of those cases of the more capex they do, the more demand it implies to some extent, and then the markets.
Where's the risk in that? Because the reaction to Meta was kind of interesting. You got a sort of differentiated reaction last week, which was interesting. I bet it's coming to the market. They're spending big. They're issuing debt now to try and finance this. Like where that shows up on the balance sheet, or if at all, I don't know. But you got a kind of negative reaction. So the market's becoming a little bit more nuanced in terms of its approach to whether or not different companies will be able to deliver from this gargantuan spend.
Yeah, I think if you look at the market reaction, I think the companies that have a broader offering in terms of how people can use the data centers are the ones that are benefiting the most. The ones that have a cloud business have a very sort of clear AI strategy in terms of services that external customers can use. Those are the ones that are benefiting the most. So if you have a cloud offering, you can use data centers for that as well, whereas some companies aren't able to offer that.
Bilal, you said you're encouraged by the Fed. Are you just ignoring Jay Powell's hawkishness then?
Pretty much at the moment. So, at the moment, the markets at least are still expecting a December cut. I think on balance, if you look at the labour market data, we get some data later on this week, shows that, payroll growth is very likely to be close to zero on average over the last 3-4 months. Powell did talk about inflation risks, but I do think that the labour market is really what they have been talking about, and I think that will be what they'll continue to talk about. So I think he just tried to introduce some two-way risk. There is some uncertainty around, how the votes will go in December, so that's a new risk that we have to contend with. But I think on balance, the cut is still on.
Makes you wonder what happens if they don't cut.
Well, yeah. You've had various bits of Fed speak kind of pushing back against the cuts, right, over the past week. But, if you look at all the talk of Sell America, right, if you look at dollar assets into Q4, pretty resilient. OK, so I just want to know, is debasement over?
I think that debasement is still on. I think right now we're in this corrective mode within the overall debasement theme, because I think in the end the Fed will eventually end up cutting rates a lot more than people think. And part of that reason is I think the Fed cares a lot more in the end about labour market than it cares about inflation, unlike many other countries around the world. On top of that, I do think that you have to take into account that Powell will be leaving next year as well. So we have a change in the whole leadership of the Fed at a time where there's much more influence by the administration on who you will take on that role. So that, feeds into the debasement trade.
Well, where is the bond market taking its cue from? We talked about debasement with Lizzie. Guy made the point around the Meta earnings piece, where the stock market didn't receive it well, but the bond market definitely did with their gigantic issuance being oversubscribed. Where are credit markets broadly taking their cue from?
It's a good question. I think there's a couple of different sort of cues. One is I think credit in general will do well as long as we don't have a recession. So I think that it's all about the tail risk more than anything else with credit. And for now, it seems like, with the scale of capex that's, in play here, a recession is unlikely. And even though there is a deterioration in the labour market, it doesn't seem like we're going to have a spike in the unemployment rate. So I think that, number one, tells you that credit market will be well supported. Then on top of that, the Fed did reverse its QT program. So I think it tells you that the Fed ultimately will be there to stabilise markets if needed. So I think credit is taking cues from those sides.
Can we just talk about the long end of the curve for a moment? We've been talking a lot on this show, and of course, I think broadly, everyone's been a little bit worried about the cracks in private credit specifically. What's really confusing to me about this is that we're concerned about the private credit markets. We're concerned about these long duration assets. And yet it's not creating any sort of changes or bids in the long end of the curve, in the long end of really any asset that requires a 10 or 30-year time horizon. Where is the cross-asset correlation for something like that? And I bring this up in the context of when we were talking about private credit in the context of some of the endowments in the United States liquidating their positions, there was an active move into the long end of the U.S. curve as a way to get that duration exposure. We're not seeing that this time around.
No. Well, I mean, we're not seeing as much of it from the flow data, but certainly if you look at the curve in general, so 5s, 30s, or any sort of measure of the curve is flatter than you would have thought, given the size of the U.S. deficit, given inflation concerns. So that tells you somebody is buying the long end at a price that doesn't seem to reflect fundamentals. So it could be endowments, could be other asset allocators. So I think there is still some some non-economic demand, you could say.
Is that related to the private credit story, or is that its own separate thing?
I think it is related to private credit insofar as, since the global financial crisis, there's been two biggest balance sheet growth items in the US. One is private credit, or private markets in general, and credit being a subcomponent of that, and the other has been sovereign debt. So you would expect that both should get repriced significantly lower, and you're not seeing that on the sovereign side.
Buffett is selling. Cash pile's enormous. He's not even buying back his own stock. Should that worry you? Are we in a position right now where you want to be protecting the gains you've had over the last few years, or thinking about the future gains to come? I was talking to Sergio Motti last week. It's interesting. UBS clients are starting to get a little bit more defensive. I'm just kind of anecdotally, you're starting to hear some of the biggest names going, just be careful here. Should we be careful here?
I think one should always be careful, but at the same time, we have had some really quite good news recently in terms of the de-escalation of US-China. I also think in terms of the AI capex story, I think that probably has further to run insofar as we're at the early stages of this type of build, and I think it's very tempting to compare it to the dot-com period, but there's some key differences. So I think this hesitation and this talk about bubbles right now, to me, suggests that, it probably has further legs to run. It hasn't become as strong a consensus.
So you want to still be all in?
I would want to. Obviously, you want to do it in a prudent fashion, but I wouldn't want to go short equities at these sorts of levels.
Bilal, can we talk about the UK budget? Gilt's had an unusually good, surprisingly good October. If Rachel Reeves, the Chancellor, goes hard and when it comes to taxing the rich and really grows this headroom, is the gilt market going to be doing cartwheels?
I think that if she does something, a tax hike, I mean, we're already seeing it. Gilts like it. So in general, I think the more aggressive she is, whether she taxes the rich, whether she raises the basic income tax, or whatever she does, if it's anything close to what people are expecting, then gilt will like that trade as a whole. Whether individuals would like that, whether people in the city would like that is another question. But I think the market is really looking for something on the austerity side, higher taxes, cutting spending, and I think that's the opposite of what previous administrations have done.
Are we going to do this every weekend now? It's just going to be the weekend papers full of...
Every Monday morning.
Every Monday morning you'll be here with your news on tax rises.
Yeah, but isn't it a misinterpretation? The market wants austerity, but the Labour Party wants taxing the rich. Ultimately, she needs to make more headroom, and maybe this could be a hit to growth by losing it in translation.
Yeah. I mean, I think in the short run, it will take time for it to have that sort of hit to growth. So in the short term, the question is, does she care more about the gilt market, or does she care more about growth? And the growth angle, already the OBRs reduce productivity, and then there's this... How do you increase productivity? That's the long-term supply side issue. So I think she's going to have to contend with different priorities, and gilts will be her bigger priority right now.
Bilal Hafiz, head of market strategy over at Macro Hive, talking to us a little bit about everything. Coming up, we continue the conversation on the bond market. We're going to talk about the story on both sides of the Atlantic. Vishal Khanduja from Morgan Stanley joins us next. This is Bloomberg.
Monday the 3rd, good morning. Hope you had a great weekend. We've got a lot to focus on this week and think about. Monday morning kind of feels a little bit risk on. We're starting a new month, so in some ways a new P&L, new things to think about. Not exactly up by much. That's the picture for European futures this morning. Take a look at US futures. They're marginally higher as well. The S&P is up by less than 0.1%. We're basically flat. The Nasdaq is a little bit more positive, but not by much, Lizzie.
Flipping over to the bond space, and we have yields a touch higher across the curve, across the European continent. The 2-year 10-year German bond yield at 2.64 right now, and it's been a late start for Treasuries this morning, Kriti.
It absolutely has. You did have the Japanese markets closed, but we are getting the initial reads here about 30 minutes into that market opening. A 10-year at 4.09, but it's a 30-year that I'm a little obsessed with over the weekend. 4.67 on the long end of the curve. Maybe our next guest can make some sense out of these markets. Vishal Khanduja, head of broad markets fixed income over at Morgan Stanley Investment Management, flew across an ocean to join us this morning. Michelle, we thank you so much for your time and for joining us around the table. I was trying to rack my brain over the weekend, because this is what I do on the weekends, is just kind of understanding why is the yield curve flattening at a time that we are still talking about consumer resilience, potential housing crisis, fund flows out of private credit. What's going on with the long end of the curve?
Thanks again, Creedy. And yes, you are not alone in that weekend brain racking on
there were other
yields.
things going on this weekend.
A little bit.
Some of us have a life, some of us don't.
I think yield curve, parts of the yield curve are driven by very different things. Like the front 0 to 5 year, I would say the 0 to 2 year is very focused on what the Fed is doing. Quite a bit of control there. As you travel up to the 5-year point, I think that is much more of the terminal rate story. And then as you get beyond that, I think then you have a lot of the deficit, supply, demand, et cetera, that story that pops in. Structurally, we do think that the long end is going to struggle because of the U.S. deficit situation. France and UK are two more examples of that same issue. So we should see the steepening in the very back end. But we've seen flattening because we had overpriced a little bit about the Fed in the front end. So I think you're seeing a little pushback on the front end here.
We talk about the deficit issue. We are into, what, week 5 of a government shutdown?
The longest government shutdown, Tuesday night into Wednesday. That's kind of when we passed
you
that
had that
milestone.
fun fact just ready to go.
Ready to go.
Roll right out of this time. But to his point, longest government shutdown potentially. We're talking about even bigger cuts to things that a lot of people did not think would even be touched, things like food stamps, military pay, et cetera. Why is the market, the long end, not freaking out about the exact reality they priced in 6 months ago?
Yep. So I think part of it is also some of the credit cracks that are showing up. We saw a few headlines cross through probably 6 weeks back. A couple names there from our perspective, idiosyncratic issues. You're also hearing about when the data actually becomes available, the clean data, you will start seeing the government actually reducing in size. You will start to see some of the effects from the DOGE department that was started off with a few layoffs coming from there as well. So the reduction there, economic cracks, which typically has a little bit more of a bid for long-end treasuries, and that's why you're seeing the 10-year, or you saw for a brief period, breaching the 4% mark as well.
OK, there's a couple of things in there. Let's start off with the credit stuff. Are there more cockroaches? I know it's the wrong bank to talk about cockroaches, but if there's bad underwriting, there's going to be more bad underwriting. Is there going to be more of this kind of stuff? And if there's more of this kind of stuff, is there a point at which we start to kind of worry about it? It stops being kind of a series of idiosyncratic events and starts becoming a pattern. Okay, where is that moment?
Yeah. Let me just start from what we've seen for now.
Yeah.
What we've seen for now, I'm going to comfortably use the word idiosyncratic.
Okay.
Sloppy underwriting, some very clear marks were missed out, and that's what we saw the effects. What is not idiosyncratic is there was a lot of capital chasing some of these deals over the last 3 years. Part of the reason why the high-yield market in the U.S. is the cleanest it has ever been. Highest amount of double Bs, highest amount of secured bonds, and the lowest amount of duration that you've seen. Part of it was that certain other parts of the economy and underwriting took the weaker part of the economy. We also then can correlate, which is not idiosyncratic, is the K-shaped recovery. You're seeing part of the U.S. economy, which is struggling at the bottom end. Some of these have come from that sort of strata, which is more cyclical.
Which explains why a lot of people are still convinced the Fed is going to cut. Because the bottom end of the K, life is tough at the bottom end of the K. Exactly. And you can see that in various different aspects of the numbers that we can get at the moment. My question to you is, at the moment, the market is going, bottom end of the K, that's where the Fed's going to cut. Everybody's still convinced that we're going to get a December cut. Everybody I'm hearing is telling me we're still going to get a December cut. I'm sure you're kind of in that camp as well. If that's the case, why did the Fed feel like it needed to put two-way risk into the market?
We are still a little confused. I think the one statement was very clearly putting the risk that we don't want 100% to be priced in. Yeah. But the other 45 minutes of the Q&A was how the economy is very, very, very weak under that K-shaped recovery from the bottom end.
So what is your theory?
So our theory is that there is definitely division in the monetary in the FOMC picking up. Clearly signs, I think, Fed, when they cannot use the word data dependent because there's no clear data to be dependent on at this point, they don't want the economy, the markets to be completely pricing them out of a probable sort of optionality that they might need at the end if the data becomes clearly convincing.
And that would be inflation data, or would that be what would it take?
It has to be labor. Labor. So the Fed is very clear from that perspective that they are more focused on labor downsides versus the temporary inflation.
So if you got a payroll print now that said 50,000,
it becomes, again, that's I think we are two-thirds of a chance priced in at this point. Probably you reduce a little bit from there because I think the pricing right now, from our base case as well, that the payroll, there might be a big chance of a negative payroll coming in the next 2 to 3 months.
But of course, the trouble is we're not getting data at the moment. Yep. So how much volatility would you expect in the bond market around, for example, the Supreme Court ruling on tariffs this week?
Quite a bit, actually. But I think if we can just take a step back, our base case of a December cut, December maybe getting pushed into January at this point, not the next December, just trying to price that for the yield curve as well. Our base case is coming from if there is not a clear data point that is coming out, the Fed will find it very difficult to convince the market to move away from what is priced into it. So, yes, I think there will be some volatility coming through the Supreme Court, but I think a lot of that has been cleared up with all the sort of trade deals that the U.S. administration is solving through across Asia over the last week and a half.
OK, so basically they need the data to cover them if they're going to do that. Just coming back to the cockroaches, you asked Guy about, when it's a point of concern. When does it become the Fed's problem?
I think it's already the Fed's problem. That's why we're pricing in 5 to 6 cuts by the end of 26, beginning of 27, because the monetary policy has to be effectuated for the whole economy, not just the top 40% of it. Big banks, AI, capex, etc. That part of the economy is doing robustly strong, and the best is yet to come, probably in the next 6 months, with all the deregulation, etc., which was the fourth point of the Trump administration. Mm-hmm. But the monetary policy has to be effectuated for the remaining 60% as well. That's why you're seeing so many cuts being priced in.
Is there, though, just given that so much of with the capital markets having basically been closed for about 2 years, is there enough lending growth in the public and the private markets to offset any systemic risk that could come from these cockroaches? Is the lending activity moving fast enough to minimize those risks?
So I think very clear data set will be beginning to middle of 2020, when the capital markets almost shut down, screeching halt till the Fed came in and started the liquidity back up again in the primary markets in the U.S. I think that data point very clearly tells us that private works and the underwriting there will keep the economy on. I think if we apply the same thing today, I think there is more capital to be invested from the private side. So we don't think that it'll stop sort of the lending side of things. Now, structurally, the housing market, it's not about lack of lenders trying to lend to the housing market. Yeah. It is about all of us in the U.S. are stuck at 3%, 30-year fixed, no recourse mortgages. So that's free money, like a hedge fund.
You stay where you are. Give AI, we haven't talked about AI. How are you thinking about this colossal spend and the impact that it's having? Is it a zero-sum game in the United States? Is it sucking money away from the rest of the economy? How's the rest of the economy? The AI trade is kind of on, and vast quantities of money are going to be spent. I don't know what's going to happen in terms of that trade with white-collar jobs. What's going to happen there? I don't know what's going to happen in terms of capital investment into other sectors. How much of a kind of unknown at the moment is this huge AI build-out for the economy and, by extension, therefore, the way the markets kind of price everything else?
Yeah. Fantastic. And there was so much in that question, Guy. I think if we can just take bits and pieces, is it taking away a lot of capital from what could be lent out? Absolutely, yes. Is it, from a bondholder's perspective, we are getting very skeptic. I think the last week saw quite a bit of that supply coming into the investment-grade market. Yep. Securitized market is also seeing a few of those. Bank loans and high yields markets will also see quite a bit of that supply. We do think that we are still very early in that. I think the pricing of risk from our perspective at the moment, you can see very clearly where the cash flows tie into the amount of debt that's being issued. I think in the next 3 to 6 months, if we continue even half at this pace of supply from data center build-out or AI build-out in general, you will start hitting some of the metrics that debt holders get irritated with, that you're going to start hearing some rating downgrades coming through because you don't have cash flow supporting the amount of debt that is coming out from that end.
Irritated, that's a good word.
That's how we try to keep them honest as well on the balance sheet side. So from that, capital going away to the other parts of the economy that is struggling because of the amount coming here, both from the administration as well as the private markets as well. And then from a debt holder's perspective, I think we are starting to see some pushbacks coming through. Not at the moment. I think we saw a big deal being priced, 25, 30 billion being priced, with about 130 billion in the books. So at this point, I think everybody's scrambling. Still early.
Maybe go early. Get early before everybody gets irritated.
But long term, long term, we do think that the risk premiums will start to demand a little bit more.
Thanks for talking about it, CS. Really appreciate it.
Likewise.
Vishal Kanduja, the head of broad markets fixed income at Morgan Stanley Investment Management. So we're going to go back to the earnings next. RyanAir expects to exceed its passenger growth target for the full year. This is what Michael O'Leary told Bloomberg earlier.
There's a reasonable prospect now we're going to be growth 3, maybe we might get to 4%. It's from 200 to 207 million now, so we've got 3.5% growth for the full year.
MOL, a few minutes ago on Bloomberg. RyanAir, just one of the stocks that we're going to be watching. It is a busy, busy week for earnings. O'Leary kicking things off, plenty to discuss. That's next. This is Bloomberg.
Welcome back. Now, Eni and Petronas have reached a binding agreement to combine upstream assets in Indonesia and Malaysia. And Eni's CEO has been speaking to Bloomberg's Romana Basecci at the ADIPEC conference in Abu Dhabi about the oil market.
What we are seeing, the actual data that year after year the demand is growing. Now we reach 103 point something million barrels per day of demand, and the supply is more or less the same. But what we know that we are investing half of what we were investing more than 10 years ago, and the demand is much higher than 10 years ago.
So you don't think there's enough investment going into
No, there is not enough investment. Also, the IEA said that we need, before they said that we have to stop investing, but now they say we have to invest more, because what we are investing is nearly enough to fight the depletion. So that is the point. So we have a demand that's growing, we are not investing enough, so maybe we can have a oversupply for 2026. I don't know how much. They say 3 million, they say 1 million, they say 2 million. That is not easy to forecast, but that is not something that is going to continue. We have to consider also the geopolitics. Now, with the last sanctions on the Lukoil and the Rosneft, we know that Russia cannot export about 3 million barrels that before they were exporting to China and in India. That is something that is going out of the market. So it's not considered in this oversupply. So I think that we have to be very cautious, because if you say that there is an oversupply from one side, you say that we are not investing enough from the other side, you reduce investment, then what you produce, a peak in the oil price, and that is not good for the society.
Yeah.
So that was the Eni CEO, Claudio Descalzi, speaking to Bloomberg's Romana Basecci, and she'll be bringing us plenty more conversations from ADIPEC, including interviews with the ExxonMobil CEO and the chairman of Gunvor Group. What a week to be at that conference, given all the moves in geopolitics and the OPEC meeting over the weekend.
She's also got a panel coming up which has the BP CEO on it.
There you go.
9:15 UK time. So we'll have that conversation a little bit later. We'll find out about this deal that they're doing in the Permian. Got earnings tomorrow as well, which is going to make that conversation even more interesting. OK, what are we going to talk about next? Let's talk about where the dollar goes. Well, let's figure out the answer to that question, and we can pretty much take everything else off the back of that. Marcus Live, Executive Editor Mark Cudmore, joins us now. Mark, you like the dollar. You think it's got legs?
Yes, absolutely. Good morning, Guy. I think this is in context that FX has been really boring for the last few months. The dollar was a big story the first part of this year. It's been the key part of why the end of US exceptionalism has been a valid theme for 2025. It's been partially through the dollar component and then partially through stocks market lagging only slightly. So the dollar was a big part of the first half of the year, probably one of the most important themes, as it seemed like the world was kind of diversifying, has been diversifying to some extent. Then it's been quiet since then. we're now seeing dollars starting to break out some of its ranges on some of the most important crosses. And I think this is a theme that's got a little bit of legs into year end. There's slight upside in yields. Powell implied last week, he made a kind of a slight slip when he said we might resume rate cuts, which implied that he is definitely in favor of a pause in December. Some other speakers since the Fed meeting have come out and kind of said that as well. Given the lack of data, they are inclined to kind of pause. The private data we had in October said the economy is holding up okay in the US. So I think that with about 70% price for December Fed cut priced, there's upside in rates. That'll support the dollar move where the market is still slightly offside. So I think that's the year-end trade, and that will feed into other assets.
Mark, when it comes to feeding into other assets, I keep feeling like the correlations, the cross-asset correlations have completely broke down. You see a meltdown in gold, it doesn't affect any other asset. You see worries in private credit, it doesn't show up in the bond market. What are the ripple effects of a swing in the dollar?
Yeah, that's entirely fair, Critty. And I sometimes I make the assumption of kind of jumping like Pavlov's dogs to the old correlations, which have broken a little bit. I go back to the idea that the underlying story that dominates absolutely everything else is AI. And I don't think that the AI bubble is close to bursting. I think we might be moving into the more volatile stage. So we're talking about, the kind of, if you want to go back to the dot-com comparison, we're going to the second half of 99 into the early 2000s, where we got, multiple 10% corrections, but ultimately the stock market doubled. Now, I'm not saying we're going to get the scale of those moves, but we're probably in a more volatile period for the AI bubble. And that is eroding correlations elsewhere because people are still programmed to buy the dip in risk assets. That said, higher dollar, higher yields is still a tightening of financial conditions at the margin. So I still think it weighs in things like precious metals and cryptocurrencies, even if it's not as strong as before.
What about the yen, Mark? Japanese markets have been on holiday today, but does the yen weakness continue on the flip side of dollar strength then?
Yeah, very much. The structural reasons for yen depreciation remain very strong. Deeply negative real yields, terrible growth outlook. Sure, there's a change in politics at the top, but that's going to take a long time to feed through. Ultimately, I think, yen continues to weaken. It's where the market is also offside on this. So dollar yen goes higher. Sure, we might see increased verbal rhetoric, pushback from officials in Japan, but they're not close to intervening yet. I think we've got to go at least above 158 before intervention is a serious risk, and maybe quite a bit above that.
154 is where we're at right now. Bloomberg Markets Live Executive Editor Mark Cudmore, we thank you. And you can get up-to-date analysis from Mark and the team by going to MLIV Go on your terminal. Let's go to stocks to watch now with Chloe Melly. We heard from Michael O'Leary just before, and we start with RyanAir.
Good morning, Lizzie. Yeah, let's start with RyanAir today. After it lifted its goal for passenger growth for this year, thanks to really strong travel demand and also improving Boeing deliveries. So Boeing had been really struggling to deliver those planes on time for RyanAir, and that had led RyanAir, which is the biggest Boeing customer in Europe, to scale back some of those growth ambitions. But it seems that now the worst is over and things are improving. The CFO said that things are humming along quite nicely and the quality is there. So we could see that boost in the shares for RyanAir this morning. This is an airline that's already been really outperforming its closest budget airline peers. As we can see, EasyJet and Wizz Air really struggling while RyanAir really soars there. So that could continue today, and we could see that market receiving that upgraded guidance on passenger traffic quite well. Moving on to Nestle, which has been upgraded to a buy rating by Berenberg. Berenberg analysts have said that although Nestle is set for its worst performance in 20 years this year, they should hopefully be the bottom for Nestle, and it should be improving from then on. So we could see maybe a boost there after what's been quite an up and down performance there for Nestle. This also now means that it has only one sell rating on the stock, a majority of buys and holds. So it seems that analysts are buying into this recovery story for Nestle moving forward. And finally, let's go over to the renewable energy space. And A2A, an Italian company in that power generation space, has been upgraded to a buy rating at Morgan Stanley, saying that it is an under-the-radar beneficiary of a data center build-out in Milan and the surrounding region. So we could see that stock going even higher after it's already been quite a good performance, quite an impressive performance over the last year.
All right, Chloe Melly with some of our stocks to watch. We thank you so much. I'll add another one to the list, and that, of course, is BP. We continue to monitor this. They had some headlines that broke this morning. They're selling their interest when it comes to the Permian Basin and Eagle Ford assets for $1.5 billion. Just for our international audience, this is basically the oil-rich parts of the southern bits of the United States. This is crucial. We know they have a promise to divest about $20 billion by 2027. They have a massive debt maturity wall also in 2027. we're lucky to have a couple conversations with the CEO coming up.
Well, Jemana's about to have one.
Yeah.
9:15 UK time. She's going to be on a panel with the CEO, and then interviews tomorrow.
Yeah, their earnings coming out 7 a.m. right here on the opening trade.
Look forward to that conversation. What else are we going to be factoring in this Monday morning? So it starts quiet this week in terms of the earnings. We've had RyanAir. I slightly feel as if Michael O'Leary's being a little cautious, maybe a little circumspect in terms of his outlook. Europe is very capacity constrained over the next few years. So how much are we going to be seeing in terms of decent numbers coming from RyanAir in that kind of a market? Particularly now it can bring extra capacity in. But we really start to get into the earnings later on this week. There's a few big pharma names going to be reporting. So we've got AstraZeneca this week. We've got Novo Nordisk this week. I'm going to be in Copenhagen Tuesday, Wednesday to talk to the CEO. That's going to be a fascinating conversation with a big piece of M&A happening there. But it's a big week for European earnings. Kind of how much volatility are we going to see in single stocks this week? Feels like it's going to be reasonably quiet this morning, but throughout the rest of the week, it could be an interesting ride on the single stock story. Anyway, that's the futures picture right now. US futures are a little positive as well. The opening trade is up next. Monday morning, 3rd of November. November's upon us. Let's talk about Thanksgiving. Not Thanksgiving. Thanksgiving's coming. Let's talk about Halloween and kind of how Halloween went. This was the market over in the United States on Friday. As you can see, this is where Europe went out. We bottomed out a little bit after that, and then we rallied. To be honest, Europe went out here, and this is kind of where we finished. So I'm not actually that sure there's much of a read across in terms of where we left the US markets to where we find ourselves this Monday morning. And Critty, I think that probably is reflected in European futures.
Halloween, Thanksgiving, I'll add Christmas in there because we have red and green on the screen, but not by that much, which to your point, I think is significant. Your Stoxx 50 futures virtually unchanged. Your outperformer this morning is the FTSE 100, but again, only higher by 0.2%. I wonder how much of that is an oil story that we're going to keep an eye on. Of course, the DAX also higher by 0.1%, but Lizzie, rescue me here. Give me some action.
Well, we're going to keep an eye, Critty, on RyanAir. They've said that they expect to exceed their passenger growth target for the full year. They've got aircraft early from Boeing, demand for travel staying strong, so a strong outlook there from RyanAir, but as Guy says, O'Leary staying cautious, so let's see how that opens. We've also had the breaking news out of BP this morning that it's going to sell its stakes in its US shale assets for $1.5 billion, and we're minding Nestle as well because Berenberg's upgraded them to buy from hold. So just some of the stocks to watch at the open, Guy.
Okay. But it's a new month, and that means a new P&L and a new way of thinking, or maybe the old way of thinking just carries on. That certainly seems to be the narrative. It does still feel like a front foot market. I agree. This morning, futures don't put us kind of sharply ahead, but we had a decent week last week. You've got to think about that. That's the context. Kind of carry it on into this Monday session. So here we go. Let's show you some numbers, give you an idea. As we expected, the FTSE 100, maybe a little bit more positive than other markets around Europe. Be interesting to see how BP opens this morning. The IBEX is absolutely flat. This feels like it's going to be a very unexciting open. We kind of big it up. It's going to be an exciting open. BP, I'm told, is up quite nicely, which is maybe giving the London market a little bit of a lift. Well, you've still got AstraZeneca to come this week, a whole raft of earnings coming through this week. So the Stoxx 600 is flat. The FTSE 100 is a little bit positive. The CAC is absolutely flat. A lot of politics still to factor into our thinking when it comes to the French story this week. But we will wait for the DAX and we will wait for the SMI. We'll see what we get through on the Nestle front. OK, Lizzie, what do you got? Sectors, single stocks, what's moving?
So the best performing sector this morning, Guy, is energy, up more than 1%. As you say, BP shares outperforming off the back of that news that they're selling their stakes in the US shale assets. So the individual shares up 1.9% at the open. Then behind energy, we have autos, telecoms. About, well, just under half of sectors are in positive territory this morning. It's basic resources at the bottom of the basket, down 0.7%. Travel and leisure not far behind, down 0.4%. We're still waiting for RyanAir, though. Nestle shares up 0.3%. Not a huge gain, Critty, after that upgrade from Berenberg. And we're, those are just some of the stocks to watch at the moment. But not a huge amount of movement for a risk on Monday.
not a huge amount of movement. I will say, I think I was expecting maybe something a little bit different. You're right, oil is definitely the leader across the board, but take a look at some of the downside movers, at least when it comes to index contribution. I'm seeing a little bit of healthcare. I'm seeing a little bit of some of the private equity names like EQT, for example. I'm also seeing some of the tech names take a step back. ASML, Schneider Electric. This feels like a little bit of a hodgepodge kind of day, Guy.
Doesn't feel like BP. Feels like BP's moving with the crowd, though. Doesn't feel like it's moved. Doesn't feel like it's moving with maybe the news when it comes to the Permian. Shell is the biggest points gainer this morning. BP's just behind it, but they're both up kind of 1.5%, 2%. So we're seeing some movements there. RyanAir, I just think I saw a trade on RyanAir. I think it was soft, actually, down on the back of its numbers this morning. Maybe O'Leary's been too cautious. He's in a market.
Out of character.
Yeah, well, yeah, but I think he's trying to, in some ways. He doesn't want the market racing ahead. He's in quite a good operating environment at the moment, and I do wonder whether or not they've kind of pulled the enthusiasm in a little bit too hard. Elsewhere, Novo's up, but remember, Novo got battered at the back end of last week. It's basically in an M&A fight now with Pfizer, so it's going to be interesting to see how that one works out. So its stock got hit hard. I wonder whether you buy it at the beginning of this week as we approach maybe the earnings numbers that come out later on this week. And defence names look like they're on the front foot a little bit as well. You've got some big defence names reporting numbers this week. I think Rheinmetall's out later on this week as well.
But broadly, the Stock 600 pretty much flat as a pancake this morning. Let's get some analysis from Beata Manfi, European Equity Strategy Head over at Citi. And we've talked about Halloween, we've talked about Thanksgiving. Are we going to have a Santa rally, Beata, on the European stocks?
Let's see about that. We have quite a few pieces of data to determine, coming out to determine whether we are going to have it or not. But in general, the future doesn't look bad for equity markets, right? So we have the world from an economic perspective where China or Europe are relatively resilient, picking up from low levels. Then, yes, you have the US economy slowing down. Our view is it's just a slowdown. It's going to be soft or no landing. And all of that backdrop underpinned by the Fed cuts. In this type of environment, all the major indices go up together, right? And they especially go up when the Fed underpins the markets in the environment when a recession is avoided. So our view is don't think that much about the regions, but it's more about the sectors and themes. This is where the overall alpha is going to be.
Well, let's talk about the sector and the theme that is AI. I'll leave the bubble talk to your US-focused colleagues, but in Europe, how do you play it? Are you looking for other infrastructure names? There was a load of hype about Nokia, and then, of course, NVIDIA puts its investment in. Who would be the next Nokia that's going to get a massive gain that NVIDIA might have their eye on?
Of course, AI continues to be a very powerful theme, but it isn't the only theme. It is picking up on steam with the current reporting season, definitely. But there are other themes going on in Europe, right? So we have the fiscal, we have that continues to deliver. It's just going to be gradually delivering, underpinning growth and EPS in Europe. That's helpful. This is why we like banks. This is one of our main overweights. In terms of tech and AI, of course, Europe has a very difficult job because from the market cap perspective composition, it's less than 10% of the market cap, right? So you can play it. So for us, the infrastructure plays in to do with tech, with the build out of data centers. That's something to look out. But of course, it's a much smaller scale. That it's not going to be the main driver of equity returns in Europe as it is in the US. You need these other things and cyclicality to work for Europe to do well.
Well, you mentioned the fiscal. You say you like the banks. Are you not worried about what the French lawmakers might do, what the UK lawmakers might do when it comes to the banks?
Look, my positivity is through lots of worries. There are always worries, right? Now, more important is what is going to happen to growth and credit creation into the next year. Of course, worries from the UK, worries from France, but broader banking sector could continue to do well into the next year for very different reasons that it has been doing this year. And when I look at what the analysts are doing with their earnings forecast, this is one sector that consistently has been and continues to be upgraded week after week. The earnings justify expectations and continue to move higher.
So you're positive. You feel kind of risk on, except you're risk on the defensive sectors. You're risk on tech, tech, banks, which largely driven by buybacks. Is healthcare part of that basket for you?
Healthcare, well, it depends what you define defensive or cyclicals, right? This year has been a very mixed bag, and certain sectors that have been one or the other have behaved differently. Yes, so in the domestics, we like banks, we like real estate. In the consumer sector, at the beginning of September, we've upgraded to retailing. We do like travel and leisure. And then in the internationally exposed sectors that have been the most beaten up through the strengths of euro and tariff risks is tech and healthcare.
And are you worried there about margin compression? Are you still worried about tariff risk at all, or is that something that's fully priced in?
We think it's going to continue to play out in the economy. We haven't seen the full extent of it, of course, but they are much better understood. And the most important for us is we now know who is paying the tariffs. And when I look at the U.S. import prices, it is pretty obvious that it is the U.S. side, the importer side, that is paying the most of it, right? And we think that's going to continue to be this way. Perhaps the balance changes a bit, but the majority is going to be paid by the U.S. side. The biggest question is what happens to the euro. So the tariffs at the end of the day haven't been as big of an impact, negative impact in Europe as we feared. But of course, the euro strength has been.
Is that going to go away soon?
We think we are at a point of leveling out of euro-dollar and actually euro weakening into the next year.
Am I going to do better in my portfolio in November if I invest money outside of the United States or inside the United States?
We are arguing that you need to hedge your bets. So we are still in AI, in tech in the US.
Yep.
But because of the valuation constraints,
yep.
We argue you should, first of all, broaden AI into other markets. So for us, China, Korea, within the emerging markets are the top pick.
Yep.
And then just go into more cyclical markets like continental Europe for this diversification bit. If actually the world is not a worse place than it's been this year, if the situation improves.
In terms of how you would segment that, do I just buy Europe broadly? Can I buy Europe broadly? Do I avoid France, buy Germany? Do I buy the UK because of the resource trade? Nuance that for me.
It is quite nuanced, yes. So you still, over the longer term, you continue to buy what has been working in Europe, i.e. the stimulus plays.
Trade is still on in Europe.
Yes, over the longer term. Over the short term, we've been arguing for a month and a half that the internationally exposed stocks that have been beaten up and where the EPS has gone down the most, they are at a point of inflection. We are already seeing it in the UK market. In Europe, we are seeing stabilization, no pickup yet. But when this happens, this is you buy the laggards there. So short term, they will do better. But if you have the view of the next 12 months, I would do a bit of internationally exposed stocks and a bit of the winners from the domestic story.
But you're underweight the UK, right?
Recently downgraded, yes. So the UK is a very nuanced story, right? So in our global allocation, we look at FTSE 100. MSCI UK, and we've been overweight until very recently. Now, because we have this more cyclical, pro-cyclical view into the next year, the UK market, FTSE 100, is very domestic. So when the market wants cyclicality, it might not do as well. But as I said at the beginning, all the indices will do quite well. In the UK, what we like is the domestic stocks, so FTSE 250, where we see inflection in the EPS. There are some of them already, so derated stuff that is improving and that has rate sensitivity, because now we have more evidence that actually Bank of England will be able to cut as inflation is coming into control, and also you see signs that the budget is going to have some fiscal constraints.
Well, I was going to ask you that. You like domestic stocks even though maybe it's consumers who will get hit?
Only those where we already see evidence that the downgrades are abating and the upgrades are starting on the EPS. Only those. So the UK is particularly nuanced.
Excellent. Really nuanced this morning. Beata, nice to see you. Thank you very much indeed. Beata Menthi, European Equity Strategy Head, joining us over from Citi. Let's talk a little bit about what we are seeing in the Core 6 this morning to give you a broad picture. Tech looks like it's bid. Nestle's up around 0.7%, so that upgrade seems to have gained a little bit of traction. Novo battered at the back end of last week, getting a little bit of traction as well. Defence names, Rheinmetall is going to report numbers later on this week. What else are we watching this morning? It's been a long weekend. It seems a little early for a drink, but that's where Chloe Melly's taking us this morning.
Good morning, Guy. Yeah, the maker of Aperol Campari is down this morning after Italian prosecutors ordered the seizure of 1.3 billion euros in shares from the holding company that controls Campari as part of a probe into tax fraud allegations. So that is really driving down the shares this morning, and as we await more detail on that probe, we will probably see a little bit of weakness in that stock. Moving on to BP, which is doing quite well this morning. The oil major is up after divesting stakes in U.S. shale assets for 1.5 billion euros, $1.5 billion. So it is up 1.79 this morning. It is going to be reporting also tomorrow, so we'll get more detail on that strategy to try and shore up this balance sheet.
Yep,
Okay.
we'll look forward to that. We're going to hear part of the conversation from BP a little bit later on. Chloe, thank you very much indeed. We're going to see the CEO on our air very shortly, 9:15, in conversation with Giovanna Basecci, and we have BP earnings tomorrow to factor into our thinking as well.
Yeah, this is one of those stocks where the debt story and the physical asset story and the stock story all come together, and a little bit of geopolitical risk there to sprinkle in.
Do you start to think, though, of these companies as also part of the AI trade? Are they part of the energy solution? Is that how we should maybe start to think about them? Some of the US names are starting to come under that umbrella broadly. The shortage is in energy. The shortage is in energy molecules. Do we need more gas? How do you make that trade work? And can you include some of the energy companies within it?
Well, this is what I was expecting Beata to say when I asked her, how do you play AI in Europe? When you look at clean energy stocks, that's what a lot of analysts in her position are saying, that you should be looking at. Utilities is the way to trade it in Europe.
Well, the natural gas story over in the States is the key one there. There's a company called EQT, which here is a private equity company, but there's an EQT US, which is basically a pipeline company that has been getting a ton of kind of infrastructure spending as well. They're starting to see an AI premium get built into their stock, which is something you don't see very often. No,
but here in Europe, I was reading an article the other day talking about Prysmian. It's a cable company. It makes cables. Yeah. There's a shortage of cables at the moment to connect everything together. You need these kinds of cables, and there are very few specialists in the world that deliver upon them. So you're starting to see this breadth coming in. Now, some of that's already been spotted. Some of those are already stocks that have done very well off the back of it. But kind of as the universe of AI stocks gets bigger and bigger, kind of what gets included, and do European energy names start to get pulled into that umbrella, under that umbrella as well?
What's the plumbing and electricians company that I need to invest in that's specialising in servicing data centres, I wonder? But that's who NVIDIA's boss, Jensen Huang, says is going to be the millionaires of the future. Anyway, coming up on the programme, we're going to check back in on RyanAir after that budget airline posted a beat on second quarter profits and said it expects to exceed its passenger growth target for the year. So that conversation next. This is Bloomberg.
8:18, welcome back. European equities on the front foot this morning. The FTSE 100 maybe having a slightly better time of things. We're seeing some of the oil names, energy names, doing fairly well. But we kind of kick things off this week, and it's a busy week in terms of earnings with RyanAir. So let's talk about what's happening with what Michael O'Leary has said this morning. The company's saying that it expects to exceed passenger growth, the target it set itself for the full year. Travel demand remains apparently quite strong.
There's a reasonable prospect now we're going to be grow 3, maybe we might get to 4%. It's from 200 to 207 million now, so we've got 3.5% growth for the full year.
MOL, Michael O'Leary talking to Tom McKenzie just a few minutes ago after the earnings were released. It's a decent set of numbers. So the stock has rolled over a little bit this morning. We've gapped down on the back of what the company has said. But the last couple of days have seen the stock running up. We're basically kind of where we are almost exactly in terms of the average over the last 10 days in terms of the stock. So when you look at that, just bear that in mind in terms of what you're seeing on the screen in front of you, down by 2.36%. Kate Duffy, as ever, covers this stock for us here at Bloomberg. So what's the takeaway? Michael is basically looking at a fairly good operating environment. He's capacity constrained here in Europe. He's getting more jets now that Boeing's getting its act together. Like, it's a fairly positive picture.
It absolutely is. And so they had a solid set of numbers this morning. Obviously, profit after tax was up on the previous year. They also announced an interim dividend, which is always a good sign.
Yep.
And they've lifted their passenger traffic forecast, which is the main thing that we're looking at, to be honest. They previously expected 206 million this year. Now they're looking at 207. So it's inching up. And that's really important because they previously cut this because of the late Boeing deliveries that they were seeing. So this is an improvement. It's a sign of progress with Boeing, and obviously that trickling through to customers.
He also wasn't shy in his commentary on Rachel Reeves, the UK Chancellor. What did you make of it?
Yeah, I mean, he definitely expressed his frustration, let's say, towards the Labour government and, you know, just in case they do decide to raise taxes, specifically aviation taxes. And his answer to that was, actually, I'd remove 10% of capacity from the UK. So we'll see what happens in the budget. It's a lot of speculation at the moment, but that would be his response. So.
And what about the supply chain concerns I feel like are maybe looming over every airline carrier? What does he have to say on that?
Yeah, I mean, obviously RyanAir has been bogged down by a lot of Boeing delivery delays over the past year. They've been one of Boeing's most vocal critics, very outspoken about their frustration towards the delays. But now we're seeing a lot of progression. We're seeing improvement in those. And he has said, you know, that they're coming early. They're going to get aircraft in time for next year. And that means that they can up their passenger forecast goal, which is what we saw this morning. There is still a lot of capacity constraints in the industry, not only aircraft, but also engines as well. So this is not just RyanAir's problem. This is across the industry. A lot of airlines are seeing this. But for RyanAir, it's a good sign. And they're visiting Boeing. They're seeing improvements. And they're pretty happy with what they're seeing.
All right. Kate Duffy, our airline reporter, correspondent, kind of knows everything about the sector. We thank you so much walking us through those RyanAir numbers earlier today. Let's stick with the transportation space if we can. Chinese EV maker Seres has raised $1.8 billion after pricing its Hong Kong listing at the upper limit. Now, the deal is Hong Kong's 8th listing this year that raised over $1 billion. I want to go to this and other top stories in the auto space. Craig Trudell, our global autos editor, is all over it. Craig, let's start with the Chinese EV space and then we'll broaden it out. Just walk us through why we care.
Yeah, I mean, with Seres, the Huawei relationship is a really big one, and it's been hugely productive for them. I do think it's going to be interesting as Huawei has, you know, ambitions to sort of build more of an ecosystem, to become more of a player in the space more broadly. That for me is the question about Seres is you know, you've kind of got quite a bit of eggs in this one basket. And that basket, you know, wants other, I don't know, I guess to continue the metaphor, other companies to put theirs in as well. And, you know, that being said, it absolutely has been the case that as we've seen China's EV market go from already very competitive to all the more competitive, this has been one of the players that has really, you know, squeezed some of the leaders, BYD being chief among them.
Yeah, the stock is down. BYD is getting hammered at the moment. Just walk us through the kind of backstory on that.
Yeah, I mean, we've had now 2 straight quarters of profit decline for BYD, 2 straight months also of sales decline. And this was a company that we just got used to
yeah.
You know, growing and growing, you know, month after month, quarter after quarter. I do think that there's been real concern within the Chinese government about the extent to which there's you know, just really sort of cutthroat competition, and to the extent that you have some of the biggest players kind of weaponizing their size, and perhaps we're seeing you know, some real crackdown in that.
Does that mean we're going to see more BYDs here? Is that kind of how this is going to work? They're also going to try and manufacture here as well.
They absolutely. I think you have to acknowledge, you know, the momentum that they've shown in Europe, and particularly here in the UK, where you don't have the higher tariffs that you've had with the EU. You've seen, for all the challenges that BYD is having in its own market. I mean, last month, in the month of September. BYD was absolutely selling like gangbusters in the UK and across Europe.
And two things. Is bad news for BYD good news necessarily for Tesla? And where are we up to with the door handle investigation for Tesla?
Yeah, I think with Tesla, of course, they're protected in the U.S. market with the Chinese players not even really being able to contend there. Of course, you have your own sort of set of issues with the tax incentives falling by the wayside. Last night, we reported on sort of a next wrinkle in that doors investigation that Bloomberg has been all over. The National Highway Traffic Safety Administration sort of taking an initial step in a defect investigation affecting the Model Y doors. And what was most interesting to me in this letter that I would encourage people to go read is that it's not just the case that the agency is asking about just the 2019 Model Y, which is the subject of this investigation. They're asking about data for other model year Model Ys and also Model 3. So that, to me, at least, is some indication that there could be potential for NHTSA to say, hey, hang on a second here. You not only have complaints for this model that we're investigating, you have an awful lot of complaints for these other models, and it suggests some potential for that investigation to broaden somewhat, and substantially so.
Given that, how exciting is the AGM going to be this week? Presumably this is going to be a subject of conversation, but also very, very substantial pay packets for Elon Musk. I
mean, I think back to last year's AGM, and it really was almost uncomfortable, just the intensity of the fanhood. I'm not making any judgments here, but there was someone who literally said he was shaking in Elon Musk's presence. So that'll give you a sense of how I expect things to go this year.
All right, Bloomberg's Craig Trudell, we thank you. I'm sure you won't be shaking as you're covering that AGM, but we look forward to it regardless. Coming up on the programme after this weekend's OPEC Plus meeting, we're keeping an eye on oil. Brent currently trading, let me find it, it's currently up 0.3% at $64 a barrel, just shy of $65 a barrel. And we're going to be talking to Michael Haigh, head of FIC and Commodities Research over at SGCIB. That conversation coming up. And indeed, it's been energy that's at the top of the stock basket here in Europe. It's still up 1.3%, driving the gains, especially when it comes to London. The stock 600 more broadly up 0.25%. So that conversation coming up next with Michael Haigh. Stay with us. This is Bloomberg.
Welcome back to the opening trade. About 30 minutes into today's session, and we are rallying quite a bit. Look at the outperformance here. The DAX higher by 0.6%. Even if you round up, it's almost 0.7%. The rest of the continent not really following suit, but still green on the screen. A real turnaround from where we were in futures just an hour ago. Guy, what's going on underneath the surface?
Some interesting trades, actually. Worth paying attention to this morning. Energy names are definitely on the front foot, but actually it's a reasonably eclectic mix. 315 up, 266 down. Market's reasonably balanced. Volume's a little on the light side, but not really anything to speak about. Let's talk about kind of where we are in terms of the stocks that are driving us higher. Siemens Energy's on the front foot. That stock is up quite nicely. The insurance names are coming back. It's interesting to hear what Warren Buffett over at Berkshire Hathaway had to say on the insurance space this morning, but Allianz is up. The story, I think, though, this morning is in the energy names. BP is up by 1.27%. You've got this story about what is happening in the Permian, but actually there's a bigger story here, which is that oil prices are broadly higher on the back of what we've heard from OPEC. We'll come on to that subject in a little bit more detail in just a moment. Downside, let's talk about what we're seeing here and what we are getting on the downside. As I say, the market's reasonably balanced. Some of the banks are rolling over a little bit. Rio Tinto's down. You've seen some data out of China on the industrial front, which maybe is a little bit weaker, which is explaining why we've seen some of these names coming lower. But you've also had a really strong run in copper recently. RyanAir down by 2.48. I would just urge you to widen the lens a little bit on that one. Last couple of days have seen strong performance into the numbers. We're fading that a little bit this morning. Reasonably flat, actually, on a 3-4 day basis on that stock. So that's what we're seeing in terms of the single names. What else are we watching, Lizzie, that we need to pay attention to?
Well, let's remind you of our top stories this morning. Bloomberg has learned that the Chancellor, Rachel Reeves, is weighing new taxes on the wealthy to plug a budget gap of as much as £35 billion. Sources say the options include an exit charge for rich Britons and higher levies on luxury homes, moves that that could reshape property and capital flows. Treasury officials have said to have drawn up dozens of tax options for Reeves to consider. In France, the Prime Minister Sébastien Lecornu has called for closed-door talks this week to rescue his 2026 budget. The Socialist leader in the National Assembly said on Saturday that his party wouldn't approve the budget in its current state. Lecornu has ruled out using Article 49.3 to push the budget through, which only adds to investor jitters over efforts to curb Europe's largest deficit. And Berkshire Hathaway's cash pile surged to a record $382 billion in the latest quarter as earnings jumped at Warren Buffett's conglomerate. The firm's cash hoard grew as Buffett avoided deals during the quarter. Insurance underwriting profit more than tripled meanwhile. Berkshire declined to buy back shares for a fifth straight quarter. Pretty.
Fascinating moves, of course, coming from Warren Buffett, the Berkshire Hathaway investor, who, by the way, is no stranger to the energy space, to the value investing, and, of course, what's going on in the Permian Basin, which takes us nicely to the oil conversation. Oil, of course, advancing a fourth day after OPEC Plus said it planned to pause output increases in the first quarter of 2026. It follows another modest hike for next month. Now, the organization said it would raise production by about 137,000 barrels a day come December. It matches increases scheduled for October and November. Our very own Jumana Bursechi joins us from Abu Dhabi. She's following the story very, very closely. Jumana, just walk us through the thinking over at OPEC.
Well, judging by the price action now and the fact that oil is basically unchanged, moderately positive, maybe OPEC Plus were right with their decision to actually pause on and bringing extra production to the market in first quarter of next year because of these concerns about oversupply. That is not exactly what OPEC Plus said. What they did say is they were going to increase by another 137,000 barrels a day come December. That's in line with the prior 2 months. But then they would sit back and assess the first quarter of next year for 3 months in light of seasonal demand and how that all is going to play out. Now, you've got to remember that over the course of this year, OPEC Plus have put back more than 2.2 million barrels per day, or at least announced that they're going to put back more than 2.2 million barrels per day because of these strong seasonals, because of the supply, the good demand that's come through from China with their strategic build. That has been a big theme for the market. In addition to the fact that actually over the course of the summer, the demand signals coming through from Asia has surprised to the upside. But there is an expectation that that's all about to change in the coming months, because if you look at indicators like floating oil storage, that's rising to record highs. You look at the record amount of supply that's not coming just from OPEC, but from other non-OPEC supply too in the coming months. And you have the IEA estimating that you're looking at something like 1.5 million to 2 million barrels per day of excess capacity come 2026. So it's no surprise really that OPEC are holding off. But the big signal to market is that they actually can adjust based on market conditions. Now, the other big question mark underpinning all of this is, of course, geopolitics. And one of the major developments over the past couple of weeks is the Trump administration's decision to impose those sanctions on those two Russian producers, Lukoil and Rosneft. And the question here is whether that's actually going to lead to that Russian oil being taken off the market. Could that pose some upside risk to oil? Here's what the NE CEO had to say about that.
We know that Russia cannot export about 3 million barrels that before they were exporting to China and in India. That is something that is going out of the market. So it's not considered in this oversupply. So I think that we have to be very cautious, because if you say that there is an oversupply from one side, we say that we are not investing enough from the other side, you reduce investment, then what you produce, a peak in the oil price, and that is not good for the society.
Yeah.
Okay, and Jumana, you've got loads of interviews coming up.
Supply, potential upside risk. Yeah, potential upside risk coming up from geopolitics as well, Lizzie.
Yeah, and you've also got another conversation coming up. We just heard from the CEO of NE, but you're going to be speaking to BP as well at ADIPEC.
That's right. I mean, you can hear the hustle and bustle behind me. This is a huge energy conference. And yes, right now we're very much focused on that OPEC Plus decision. the short-term outlook for oil, also for LNG markets in the coming years as well, with the supply glut expected there too. But I would say the major theme this year is artificial intelligence and how that's going to impact energy complex, either via AI applications that are going to improve operational efficiency. We're speaking to some robotics firms earlier that are partnering up with some of the big oil companies here, including ADNOC, but then also the sheer power that these data centers are going to be looking for in the coming years, and what that would mean for the energy demand outlook over the coming decade. And I think for many of the players here, it's actually very welcome to hear that there are going to be new sources of energy demand, which actually bolsters the case for a complete set of energy sources, including hydrocarbons. Natural gas is going to be part of the solution. We spoke to EQT, one of the biggest natural gas producers in the U.S. a short while ago. He thinks that all of this is going to lead to massive demand for natural gas, in addition to renewables and, of course, nuclear as well. So that's one of the big discussions taking place here, alongside the need for additional investment in all of these energy sources.
Joanna, great stuff. Looking forward to the panels a little bit later on. Bloomberg's John Obasechi at OPEC in Abu Dhabi. Let's carry on the conversation and figure out what we have learnt over the weekend and where we go next. Michael Haig is the head of FIC and Commodities Research at SocGen CIB. Good morning.
Morning.
Nice to see you. Let's start with OPEC and start with kind of where we are with the oil trade right now. Cautious approach now being taken by the cartel. Are we at the fine-tuning kind of moment? Can they fine-tune the oil market kind of around these kinds of levels? Where do you think we're going to go?
So, first of all, they, as you heard from the reporter, 137,000 again in December. Pause in the first quarter. They've come out and said conveniently that, it's a seasonal lull. You'd have to be living on a different planet to realise that we're massively oversupplied. They're not going to say that. They're going to manage the market. They'll come back in January and reassess. They're meeting again November 30th. They'll take it month by month.
So is that fine-tuning? Is it possible, given the amount of oil that there is out there at the moment, can you fine-tune this market?
Well, if you look at the forward curve for oil, it's kind of in this weird shape. It's like backwardated at the front, contango at the back. It's not normally like that. It's either in one state or the other. OPEC's doing a really good job of keeping it there, as Chinese SPR buying is also assisting in that. So, I think they're kind of muddling through this process, keeping prices where they are. OPEC loves backwardation.
Yes.
It doesn't want it to go into contango where the back end of the curve is much higher, which means that you can lend more money to the shale operators because you see a higher price in the future. So they're managing it pretty well right now.
Do you want to raise the issue of AI there? And that seems to be the subject of conversation, the conversation at OPEC. How much of your universe, when you kind of think of all the various commodities you've got out there, how many of them now fall under the kind of AI umbrella? Can I trade gas companies as AI trades? Can I trade Exxon, Shell, BP as AI trades? Is it starting to become... what do investors ask you about kind of what these various commodities can do and whether or not there is actually a kind of end use for them as part of this process?
It's a really fascinating new topic, really, because 2 years ago we weren't discussing this at all. So the three markets that really come up in conversation around AI are the power markets, natural gas and copper. So if you look at copper, for example, lots of things going on there. It's had a decent rally in the last couple of months. But, if you look at estimates as to what AI and data centers could do for that market in particular, you're talking, up to 500,000 tons a year of incremental demand in a market that basically has about 100,000 ton deficit. So it's a pretty substantial incremental amount of copper.
And is that priced at this point?
No, I don't think it is. I don't think, these are estimates as to what could happen. So we're adding a little bit more into our balances on the AI data center for copper. Things like natural gas, it's very seasonal, obviously, but let's just say on average it's about, in the US, 100 BCF a day market. Roughly 1.5% on top of that from AI. So it's
not nothing.
No, it's not nothing.
Well, Michael, sticking with that theme, the U.S. grids are famous for being able to use natural gas and oil interchangeably when the price suits. At what point does that trade and that demand and push for natural gas that's pushing up prices start to feed into oil?
It's, it's really, in the olden days we used to have fuel oil, natural gas as competitive inputs into the power sector, less so now. Obviously coal has kind of moved out of the equation, so it really is just about natural gas at this point. Renewables, obviously, incredibly important. So I think on the oil side, the AI is a completely different conversation. I think it's more about natural gas and other factors that go into the power sector.
Michael, this morning we got headlines coming out of BP talking about consolidation, divesting in the backdrop of consolidation that we're seeing in the Permian. They were talking about divesting their onshore assets in the Permian and Eagle Ford to the tune of about $1.5 billion. And we know that's a kind of isolated, very specific strategy turnaround that BP is doing. But it really brings, to me at least, the question, as we talk about OPEC Plus trying to regain some of the market share, what does output from the U.S. shale players actually look like right now? Is there a concern that they're going to lose their market edge as being the #1 exporter, given the consolidation, given some of the kind of having OPEC at its heels?
Yeah, no, I mean, this is crucial in the outlook because, outside of OPEC, it was US, Guyana, Canada, and Brazil. Yeah. And so the most sensitive of those four nations is obviously the US and the Permian shale patch. If you trust our forecasts of oil and we see it going into the 50s next year, that's dreadful news for the shale patch. In fact, based on our analysis, we see US oil growth just marginally up next year.
You said 50s going into next year?
50s, yeah.
Is this a January 2026?
No, by the end of next year, $50 oil, gradual grind down to that level by the time we get to the end of the year. The IEA's come out and said that, they expect a 4 million barrel surplus, despite what OPEC is doing, despite what's going on with Russian sanctions. We're not quite at that level, but, when you're talking about an imbalance like that, the oil market falls into a massive contango. Inventories build relative to the 5-year average, and prices drop.
Wow. OK. Well, you mentioned sanctions. Do they even matter? They didn't even come up, really, when it came to the Trump-Xi meeting. They didn't talk about oil, really.
Yep.
Is it that the sanctions on Chinese purchases of Russian oil won't have much effect, that the sanctions on Russian oil producers won't have much effect?
So on China specifically, great point. On China specifically, before the sanctions in January of this year, when Biden was still in office, you saw about 0.6 million barrels a day of oil going to China in other entities outside of the sanctioned 4 that we have now. That's gone to 1 million. So that oil has been diverted from the sanctioned entities to other entities that export to China. So that's 1 million out of 1.2. So it's really nothing. India's a different story. But, with the sanctioning, there's several ways that Russian oil can still flow, right? You can have licenses to sanctioned entities, refineries that buy US oil as well as Russian oil, and they get licenses to continue to import. Russian oil now is denominated largely in rubles and friendly currencies. I think only about 5 to 10% is in US dollars now. It used to be 60%. So a lot of things have changed. So for China specifically, I think oil still flows.
OK. And I also just want to say on the geopolitics, because we've had loads of news over the weekend from Nigeria and Venezuela. Trump saying that he could go guns blazing into Nigeria. And even if he's denying that they would attack Venezuela, you've got the boats and planes circling the coastline.
Yep.
How do you think about that from an oil perspective?
So, again, that's another China story, because, out of the 1 million barrels a day of production in Venezuela, call it 600,000 goes to China. I personally don't think this is about oil. This is about drugs, other issues. I don't think there's going to be any disruption there.
Gold's at 14.14 right now. 40.14. Nice little double top in the charts. Have we peaked?
No, I don't think so. I think the only thing I'm really unsure about in gold is what hedge funds are doing. Of course, we had the government shutdown. September 29th was the last data point we saw on hedge fund positioning. At that point, hedge funds notionally had the biggest oil position they've ever had historically, 83 billion. And historically, when you've seen
gold or oil,
sorry, gold.
Yep.
And so when you've seen them at that level, they usually sell off because as a part of a macro portfolio, gold's too big. We don't know what they've done. I'm assuming that they've offloaded some of their positions, and that's why you've seen the pullback.
You buy it at 4,000 though.
For sure.
How high does it go?
Well, according to our analysts and looking at central bank buying ETF flows, 5,000 by the end of next year.
End of next year.
Yep.
Okay.
You might yet have Fresnillo on your board again, Guy.
I might well do, yeah. Good to see week highs again.
Michael, good to see you, as always. Michael Haig, Head of FIC and Commodities Research over at SocGen CIB. We're looking at gold back above that $4,000 a troy ounce level. 4,015 is where we trade, up 0.3%. But coming up on the programme, more on the biggest earnings and macro events coming up this week. That's next. This is Bloomberg.
Welcome back to the opening trade. About 50 minutes into today's session, green on the screen across the board. The DAX is rallying hard, higher by almost 0.8%. We did a check about 20 minutes ago, and it was only higher by 0.6%. So really seeing some momentum there when it comes to the German stocks. A lot of this is likely ahead of what's going to be a heavy earnings week on both sides of the Atlantic, but specifically here in EMEA. On Tuesday, we have plenty of oils companies reporting: Aramco, BP. Ferrari is not an oil company, but I'm going to throw it in there anyway. Wednesday uses oil, does something vaguely oil related. On Wednesday, we have a couple of others as well: Novo, Nordisk, M&S, B&W, Leonardo on the defense conversation, which of course continues into Thursday as well, with the likes of Rheinmetall, among others, and of course Hensoldt on Friday alongside IAG. There's plenty on the earnings front, Lizzie.
An absolute smorgasbord. So let's get some more on which earnings to look out for, specifically this week, with our equities reporter, Chloe Melling. Chloe, what are you watching?
Good morning, Lizzie. So the big one tomorrow is going to be BP. So like every oil major, this is a company that has been dealing with those weaker oil prices that have held back the earnings. But the real focus for BP tomorrow is going to be on the strategy. It's a company that's been trying to shore up its balance sheet, trying to win back investor confidence after years of underperformance. Just today, it announced divesting stakes in U.S. shale assets for $1.5 billion. So it's been really trying to communicate to the market that it is serious about slimming down after coming under pressure from activist investor Elliott Investment Management. So we'll be looking at the strategy in particular for BP tomorrow. The day after, we have got Novo Nordisk, and that is a company that has been, as we can see, struggling quite a lot over the last year. It will be trying to reassure investors after a series of profit warnings, some management shake-up as well, that it can still hit those targets, hit those financial targets. It's been coming under a lot of competition pressure as well from its closest rival, Eli Lilly. So that's going to be really key. And Wegovy, the performance of Wegovy, the blockbuster weight loss drug in particular, will be really interesting to watch after expectations that sales will slow down there. And the question really is the ability of Novo Nordisk to price that drug. And finally, we have also got Ørsted. So it will be updating the market on kind of the health of that wind sector. We've got Vestas on the same day as well, reporting. This is the first set of earnings after the $9.4 billion rights issue. And so the focus for the hope for analysts and investors is that now it can move on and talk about those operational issues, in particular in the US. And any update on some of the sales of assets will be particularly welcomed, according to analysts. So let's keep an eye on that as well.
Absolutely. Keep an eye on Novo when it comes to the M&A story as well. It's an interesting one when it comes to Pfizer on that front as well. Chloe, great stuff. Thank you. OK, so we've got a really busy week lined up. ANIPEX today, we're going to be watching out for that. Remember the mayoral votes in New York as well, Tuesday. That's going to be one you want to pay attention to. We might get some results early Wednesday morning that we can pay attention to on this show as well. Keep an eye on AMD. It's going to be out with numbers. Pfizer, Uber, also out with numbers Tuesday. Wednesday, got the US Supreme Court tariffs hearing. Honestly, this is going to be the reality TV, I suspect, of the week. Everybody's going to be watching that one to figure out what is happening. BOE on Thursday. You've got the Tesla AGM coming up as well. UMISH is on Friday. So what are you paying attention to? What's going to be the big volatility event of the week that we need to be thinking about? Neil Campbelling, Senior Market Strategist at Bloomberg News, joining us to try and answer that question. What are you watching?
Well, I'm watching, as you've already mentioned, earnings are a key factor this week. And so far, it's been great.
Yeah.
In the US and Europe, I mean, look at Europe, for example. We came in at the start of this quarter expecting minus 0.4% growth. So far, it's 5% growth in Europe. Fantastic, relative.
Yep.
And then in the US, so far, the S&P growth is 13%, expected 7%. So earnings is the one factor. I think the second factor, as per usual, is the macro data. Now, we have a problem there.
Macro data.
Well, this is it, isn't it? We have an issue with the macro data, is we're having to rely on the private data.
Yeah.
Now, the private data inherently has a lot more volatility around it. It's unofficial in terms of many of the stats. So there'll be a big focus. Well, we've
got ISM this week, haven't we?
We've got ISM today.
And UMich. You've got manufacturing today, services later on in the week.
Services in the week. We've got University of Michigan on, I think it's Friday.
Yep.
And we've got the ADP data as well. Now, the ADP data last month was negative, 32,000. We expected a pretty positive data at that point in time. Quite a volatile data set. Expected this time to add 30,000 jobs. Not a lot of jobs, but how reliable is that data? We just don't know. And the other problem, of course, is we've not had official payrolls data since the first week of September.
Yeah.
And obviously that's a long time now to wait for that.
Yeah.
I think the other factor is going to be is when the shutdown ends, we're going to have a deluge of data.
Yeah.
What happens then to volatility in markets? Because if you look at the VIX, it's very, very subdued.
17 this morning, I think,
Yeah, and it's been subdued all through the month of October. Lots of call buying of options because they're very cheap. But when we get that data officially, will that change the narrative? So that's the other thing I think we need to keep an eye on at the moment.
Well, Neil, very quickly, is this equity market just getting lucky? To your point, we have a bond market, an FX market, and now an oil market that is range-bound, largely. When we do get, at least in an idealistic world, hoping the government reopens in the United States, when we do get that data deluge, is that when the volatility shows up?
I think it's more likely than not. At the moment, the market is, with that lack of macro data, being supported by the earnings and the earnings growth. And so, in reality, we might look at Mag 7 growth or Mag 7 earnings or the wider market, but the fact is actually that the growth rates are supporting the multiples. So it's still not been multiple expansion that we've seen. So the multiples may for some people say that they're elevated on a long-term view in some respects, but actually they're not at extremes because the growth rates are supporting it. So until we get
You're that guy? The multiples aren't at extremes? According to Neil Camplink?
Yep. Of course, in pure terms, they're not. The question is, can they be sustained?
Yeah.
I mean, this is it. But the Mag 7 growth at the moment is 27%.
Yep.
Yeah.
As long as they're
spending a lot of money.
They are. That's a whole other discussion.
Yeah.
But
Neil, we'll have to watch it. Neil Campling of Bloomberg's strategy team. We thank you so much. The opening trade up next. This is Bloomberg.